covering collateralized first trust deeds. Those are your passive income assets that you hold in your self-directed IRA, and I am flat out excited to be able to expand on this type of investment that most people have never heard of, and it's been around for a long, long time. During this short period that we have together, I want to give you guys an overview on investing in real estate and real estate-based products using your self-directed IRA. And I want to point out some of the benefits to you, because if you don't understand using a self-directed IRA gives you the ability to invest in assets that are outside of the stock market, alternative type investments that will enhance your portfolio, you need to know how you can get involved in those and what the mechanics of them are. I'm Dawn Pitts, and I'm a senior investment agent with Ignite Funding. I've been working with investors across the United States, just like you, since 2009. They invest in first trust deeds using their self-directed IRAs as well as cash. I've been a real estate investor myself for over 25 years, and my portfolio consisted of a lot of income-producing properties until I started investing in first trust deeds and found that it was much easier to invest in trust deeds and have passive income and not have to do a whole lot of work. I don't have to be the landlord, but it does give a great rate of return and very, very interesting type of product for steady income. So during this time, I know you guys are going to have questions, and so what I want you to do is write those questions down and then email me. I'll get back to you individually to answer all of your questions and get you some information that will help you to be able to browse through and kind of think about these investments. But email me at dpitts@ignitefunding.com. So we want to talk a little bit about direct lending versus indirect lending and how that affects you. A lot of people out there have no idea where direct lending or what direct lending is and where those funds come from for loans. But we also want to talk about alternative investments and what alternative investments are out there and available to you. And we also want to kind of stomp down on that old myth that alternative investments are super risky or alternative investments are only for super, super rich people, because that's not true. And we want to talk about the value of diversification. So when I first started investing with a self-directed IRA, I did it for these three reasons right here. I wanted to be a direct lender, number one. Number two, I wanted to get into alternative investments because it gave me the ability to control my own returns. It gave me the ability to determine where I was going to put my money and in what projects. I was in control of that, and also it gave me diversification. I know that everybody on this webinar has a different experience level than the next person. Some people have dabbled in the stock market. Some people are experts in the stock market. Gosh, those people are like, you know, they're brainy people, I think. At any rate, there's also people that have invested in real estate. Some of you might have invested in REITs and didn't even know that you were in a REIT or what it was because your experience level just wasn't there. And some people have invested in CDs through their local bank and wonder why on earth they're only getting, you know, 0.5%. Well, we need to talk about that so you guys understand the type of investment that you're in and why you're getting the returns that you're getting and what your risks are. That's really important, and I want to be able to educate you on all those different alternative types of investments as well as real estate-based investments. And those investments will give you more control over your money and the types of returns that you're getting. So let's start off with, what is direct lending? Well, direct lending is basically, it's the transfer of funds from one lender to the borrower. And most of the time, it's going to be a bank. So they're considered direct lenders. I remember my daughter coming to me saying, Mom, I need a car. I need a new car. And I said, well, honey, you better go to the bank because Mama doesn't have the money. So you're just going to need to go get a loan. And so she went down to the bank, walked in, sat down, filled out an application, and because she, didn't have any credit at 16 years old, she found out that the interest rate was going to be really high unless Mom came and co-signed. Well, that's exactly what happens. You walk into the bank lends you the money, and it's based on your credit score. The amount of the loan and the length of the loan determines how you're going to repay that in monthly installments. Now, loans can be collateralized or non-collateralized. When you lend your money out to a company, whether you're lending it out in the form of a note, bonds, or stocks, you're lending your money out. That's exactly what you're doing. But how that money is going to be repaid to you is really, really important. If you don't understand the order of priority, you need to listen up right now, because the order of priority in returning your principal back to you might determine where you start to put your money in the future. For example, notes, they're always going to be your first priority for payback. Second priority are your bonds. So you better hope you get all your principal back. Third and last are your stocks. And this was one that always scared me, because if you understand, when you lend your money out or when you're buying a share of stock, you're actually lending your money out. Those companies are taking that money and they're buying, or they're maybe doing they want a bigger market share. They're doing research and development, maybe buying heavy equipment. They need that money within the company, brought into the company, so they can do those things. So they don't know for sure that they're going to get a return on that money that's as big as what they're hoping. So you're kind of just out there throwing your money out there and hoping like heck somebody manages the company well enough, and if they don't manage it well enough, you may not get your money back. You become a general shareholder if one of these companies goes into bankruptcy, and you're going to be the last to get paid back if there's enough money. And if there's not, you're going to find yourself like those people that invested in Lehman Brothers, Bear Stearns, number of companies out there you remember. Some of you have got caught up in it, and you're going to see your portfolio diminish tremendously. So let's get into the direct lending scenario. Now, the direct lending is your bank. So you go to the bank because you want to buy a home. And you sit down with the banker and you fill out your application. He determines your credit score and your credit worthiness and lends you the money. So now you have a note. You have a mortgage. You got to pay that back every single month with interest. And after 30 years, you get your deed of trust, and you actually own your property now. If you default, anytime in that 30-year period, the bank's going to take your home because they've got your first lien position. So that's direct lending. Okay. Now let's talk a little bit about indirect lending. Indirect lending is the use of a middleman. For example, if my daughter hadn't gone to the bank, straight to the bank to get a loan, she might have gone to a dealership, sat down with a salesman, and the salesman said, well, you know what, we could probably get you a loan through Honda. Well, that would be great, but it's not coming directly from Honda. She probably would have noticed on her credit report that about 5 or 6 companies all looked at her credit because they were trying to find a middleman that would lend the money. Same thing with a mortgage broker. If you don't go to a bank to get a loan on your home, you might go to a mortgage broker, and they'll go find a loan that fits for you. But if there's a difference in your credit score from one pull to another, it might determine the fact that you have a higher interest rate. So Indirect lending is always going to be going through the middleman. So I ask you, have you ever heard of indirect lending outside of, you know, going to get your car, or a car loan or a mortgage? Well, first trust deeds are the exact same thing. You are an indirect lender for a borrower. You actually are the bank. You become the bank. You loan your money out. You do some paperwork. There's a promissory note and then a deed of trust. So you're in a first lien position. And at the end of that loan term, the borrower pays the loan back, and you are now getting your principal back. Well, you also have a middleman that helps you work through that, and that would be Ignite Funding. So we have to go back to these alternative investments, because that's what trust deeds are. They're an alternative investment. So we got to kind of go backwards and talk a little bit about what an alternative investment is that's not a stock, not a bond, or cash, because those are your traditional asset types. So alternative investments include hedge funds, managed futures, real estate, commodities. There's a number of different things, including trust deeds. Most small investors sometimes find themselves being shut out of some of these alternative investment opportunities because they just don't have large enough funds. Well, these alternative investments like real estate, trust deeds, and commodities such as precious metals, all things that can be held through your self-directed IRA, give you that opportunity to get an independent return and perform at a higher rate of return. So in essence, you get to be the bank. Instead of the bank collecting the interest, like in the CDs, the example of the CDs that we talked about a little bit ago, instead of you getting 0.5% and the bank keeping the other 5.5%, you actually get to be the bank and you keep all the interest. And when, at the end of the day, if the borrower defaults, you'll get that property. You'll be an owner. There's a lot of different models out there that function the same way. You know, Lending Club, iPlan, Prosper.com, Equities End. These are just some popping up here just to give you an example. Ignite Funding is actually a company that does this type of lending. All of these models, though, you get to become the bank, but the amount that you start in at is going to be different with all of these different types of companies. But really what I wanted to point out here to you is that this has been around forever. I mean, this is not something new. This type of lending is not something new. If you've ever seen the movie Mary Poppins, well, I was sitting on the couch watching it with my daughter when she was about 11. I had just started in this business with trust deeds. So back in 2009, we're watching the movie, and I'm just about asleep because I've probably seen it 100 times. But all of a sudden, the three little bankers standing out on the street corner in front of the Fidelity Fiduciary Bank said, well, what are we going to do with our Poppins? And one of the other bankers turned to him and says, well, we're going to invest them in first and second trust deeds. And I looked up and I went, what on earth? Mary Poppins was filmed probably in the 50s. Were trust deeds in existence then? They absolutely were. As a matter of fact, trust deeds are what pretty much built the town of Vegas. So a lot of people became very wealthy using trust deed investments. So how are the interest rates established? Well, banks are governed by EO lending rules and regulations. So they have quotas. They have to diversify their portfolios into different loan types, different borrowers, and the loan amounts. That's regulation. So sometimes when a builder might step in the door and want lending, maybe they totally qualify for the lending, but they're not going to get it because the bank's already used up all the money that they can use up for those types of loans. So when we look at indirect lending, those interest rates might be higher But that's because average bank interest rates being between 6 and 8% for a loan, and a borrower comes in that for a loan looking for 1 to 2 million or 30 million or something, and nothing in between that. Small banks can't lend over a certain amount, and large banks won't lend down to a certain amount. They want you to either be the little guy or the really big guy, and that gap in between is exactly where this type of lending, that's our niche. That's been our niche since 1995. So when a borrower comes to us, it doesn't mean they're necessarily not creditworthy. It's just until we help them grow out of our lending and into a bigger bank's lending, they come to us because we can fund a loan very, very quickly with the number of investors that we have. We also are able to give them a 0 prepayment penalty, which a lot of larger banks will have a prepayment penalty that sometimes is more costly than the cost of our financing. So that's very appealing to them. But most of the time, it's because we can get those loans very quickly for them. So if we look at what is a trust deed, well, it's an investment in a promissory note. It's collateralized by property that's lent on, and through the use of that first trust deed, you're in a first lien position, getting investors 10 to 12% annual return on their principal, with loan terms between 6 and 12 months, typically no longer than 24. When a mortgage lender extends you the money to purchase your home, it requires a security interest in your property that takes priority over all others, right? So when you go to the bank and you get a loan, the bank is a first lien position. That lien position takes priority over all others through the use of that first trust deed, and that effectively eliminates all other junior liens that might exist. So when borrowers need money and investors have money, that's where Ignite Funding comes into the picture and serves as the middleman, bringing those two together. We do all of the due diligence on the borrower and the property. We make sure that the paperwork is done correctly, that collateralizes you in that loan, so you don't have to worry about going out and finding an attorney to do it for you. And the fact that we're governed by a mortgage lending division that oversees us and keeps us compliant, that's an important factor that you need to know about trust deed investing. You don't want to invest with a non-licensed individual. So there's certain advantages to investing in trust deeds, and I would say the collateral is probably the biggest advantage, and then comes your interest rates at 10 to 12%, and there's no fees or commissions on these type of investments. So they also give you a little bit more liquidity, especially if you diversify amongst several different loans. But you also get to select your own investment. And that was really important to me because I wanted to be able to choose where my money was going to go and the interest rates that I was going to get. And if I didn't like investing in, I don't know, Timbuktu, I didn't want to have to invest in Timbuktu. So at any rate, I was able to control those investments myself. Ignite Funding, being one of a number of companies that does trust deed investments, one of the reasons why I really love working for this company and working with my investors is because this company's been around since 1995. We've been on the commercial side of lending and the residential side of lending. We've been in the ups and downs all through, all the different market changes. But we've been able to consistently grow this company with our investors, funding these trust deeds because we have a great underwriting process. Currently, we're servicing over $71 million worth of loans, and we funded over $220 million since 2011. And the income that we've paid to our investors since 2011 is over $14 million. So we're not just helping ourselves, we're helping a lot of communities out there and individuals. We don't outsource anything. So we don't outsource the servicing of our loans, which means we're taking care of where your money is and the interest payments that come in that come right back out to your self-directed IRA. When you're going into a collateralized first trust deed, you need to know what the property is and that the underwriting has been done extremely well, and we have a process for that. You know, your average interest rates, these are just some points here about the interest rates, 10 to 12%. But one thing I do want you to notice is $10,000 is the minimum investment. Remember when I said that when alternative investments are out there, a lot of different individuals think that they have to have high net worth in order to invest in alternatives. You don't necessarily have to have that. $10,000 is the minimum, and you can have your funds working for you at 10 to 12%. You know, a lot of times advisors will tell you, you know, oh gosh, well if you're going to get 10 to 12% fixed, that's too good to be true. You can't go in an investment like that. Well, I'll tell you, they're coming around. They are coming around because Ignite Funding has established an advisor's platform. And this gives advisors, RIAs, the ability to bring their clients to us with alternative investments. So now you know what they're really doing? They're actually doing the service that they should be doing for their clients, diversifying them outside of just a room worth of products that only they can sell because that's what they're limited to. Now they have different opportunity. They can expose their clients to trust deeds and still get paid. We've developed that platform. That is exciting. You're going to see this become more and more the norm in investing with your self-directed IRA or through your own advisor. This screen, we have to go back because when we first pulled this up, I said to you there were notes, bonds, and stocks, and they were repaid in certain priorities. Well, we just inserted in there trust deeds because those are notes. They're collateralized notes, so you will have ownership at the end of the day of something if that company happens to, something goes wrong. You're going to be the owner of a piece of property. I just needed to point that out to you because you are in a first position priority for repayment. So Ignite Funding has developed mutually beneficial long-term relationships with several qualified bankable borrowers. There's just a few up here, and you might even recognize some of them. Harmony Homes, very big in the Las Vegas area. They actually were extremely present in a master plan community called the Mountains Edge. And that community was in the top 5 master plan communities, building over 15,000 homes, even in the downturn in the market. So we're really excited to still be funding for Harmony Homes as they grow. Of course, they're going to go to a big bank, and we're probably not going to have them with us anymore for the amount that we're funding now. But Jack Fisher Homes is another one, started in Salt Lake City, Utah, and now they've expanded into Colorado. That's what happens. Our investors fund loans for these companies and help them grow and build communities, and before you know it, then they're at the level where the big banks will stand up and take notice of them, and we have to move on and help some other companies like Richard Redden or Taylor Built Homes, smaller builders, but they're coming along very well. So when we work with these borrowers and they've come to us and they ask for a loan, we have to do our due diligence in underwriting. And our criteria is, I call it very conservative. To me, it's very conservative. In other words, we look at not just the credit score like a bank does, or the borrower's ability to repay. Like I said before, we look at the property and would we want to own that at the end of the day? So when we're funding loans, we're typically funding loans that are 70% loan to value or below. So that means there's a little bit of skin in the game for the borrower. and less likely that he'll walk away in a normal market. We utilize a third-party construction account as a way to minimize the risks for our investors. So if the borrower is building a home and he puts out the costs for the first phase of that home out of his pocket first, he completes the work, then he comes back to us with a signed off inspection, and our underwriter gets confirmation that the work has been done, and he then signs off on the reimbursement for those costs. So as he builds the home, he builds value in the property that's encumbered in the loan and that the investors are in a first lien position on. We're a full service lender, so we originate, we fund, and we service the loans. We do that strategically, one, because we have more control over the borrower then. If it looks like he might be late on a payment, we can get on the horn and say, hey, where's the payment? We need it in here. Our investors are expecting their interest, but we also do it because we get paid. We actually get paid to originate, fund, and service the loan. That's how we make our money, and with that way we don't have to charge, or we don't have to lower the interest rates to our investors. We annually report our performance, and very exciting, like I said before, having funded $221 million since 2011. We also, when we put out this report, it shows you the different types of loans that are in our portfolio. So we actually look at spreading it out fairly evenly across the board. We try to do that. So land acquisition, land development, and new home construction is what you'll see coming from us. Now, you like these trust deeds, you're excited about it, but you don't know, oh my gosh, what can I do to get into these investments? What kind of money do I have to have? Can I use my IRA? Yes, you can use a self-directed IRA. You can use cash funds. The financial advisors platform that we have a way to work through that with our financial advisors, trust accounts, LLCs. But really what I want to talk to you right now about is the self-directed IRA. Because when you're using your self-directed IRA, we actually walk through the whole process with you. That self-directed IRA gives you obviously tax-free options. Your interest is paid monthly. You get that investment income diversification, and of course, as the interest is paid monthly, when a loan pays off, you can add that interest into the principal, reinvest it periodically throughout a year. That will give you compounding returns and ultimately increase the average overall interest rate. But for ease of getting into these investments, we have basically made it the simplest thing for you. Step number one, you fill out an investor account form to have an account set up here at Ignite Funding. No fees to do that. Step two, you pick an investment. Step three, we send you to e-sign, electronically sign your investment documents, and from there we submit your bi-direction letter that you will have signed and those investment documents directly to your custodian. We work with a number of custodians across the United States, so we have this kind of down to a science, and our processing department actually walks that paperwork step by step through the process to ensure that your check will be here on time. We do the follow-up for you. Once you've signed your documents, that's it. You don't need to worry about it. Then you'll get an email from me saying, hey, your loan is funded, you're earning interest now, and periodically throughout the term of the loan, you'll hear from me because I want to let you know that you've received your interest payments. But it's that simple, that simple. And to get 10 to 12% annual return, it's a great way to invest your money. So I do want you to email me if you have questions, because I know that you're going to want to get some more information from me, and I've got some packets that I'd like to get out to you. So email me at dpitts@ignitefunding.com or call me directly at 702-795-5957, and I will walk you through this process. Now I'm going to go ahead and turn you over to iPlan, but I want to thank you guys so much for joining me today, and like I said, give me a call. I'm happy to help you out.